Hello, everyone. This is Joseph Trevisani from Worldwide Markets. As always, I thank you all very much for taking time out of your day to attend wherever you are in the world. And we're going to cover a topic that I find fascinating in a little bit, and that is deflation and the possibility of deflation and what that means for an advanced industrial economy, where it comes from, and the different types, and what perhaps the prognosis is for Europe, which seems to be following in the footsteps of Japan. At any rate, first I'd like to talk a little bit, since we've had such an exciting day so far in the markets, as to what's going on. This is a, can everyone see the chart? It just sort of blanked out on my side. A little bit of accounting here. I like doing these webinars more as a colloquium, as I say often, rather than a lecture. So if anyone has any comments, questions, or jokes, since I'm not very funny, on any topics at all, please type them into the chat, and I will be glad to talk about them. Or your fellow attendees may actually have comments and probably funnier things to say than I will. But please consider this a forum rather than a college lecture on my part. So what caused the gyrations this morning in the markets? And I just want to do a little bit on current events before things get carried away, and then we'll talk about the much more theoretical topics of deflation. Two things happened, of course. I'm sure everybody has paid some attention to the news. One is the Chinese tighten their collateral rules. Once again, the Chinese are attempting, and by the fact that they're attempting to do it, tells you what the government, considers the problems and the solutions. Since what they have been doing in fits and starts since the new government took over, the new administration, I guess, is to tighten credit. Well, what are they telling you? They're telling you that much of the credit that had been extended since the financial crisis is bad credit, or at least they're concerned about it. What does it mean? It means it's bubble credit. It means that it is building, in the Japanese phrase, roads to nowhere. It's building empty cities. It is construction. At one point, the employment in the Chinese economy was somewhere around 50% dependent on construction. Wait, that's not right. The growth in the economy was dependent around 15% on construction, which is an astonishing figure. Absolutely astonishing, and one that is utterly unsustainable. So that's one. There are undoubtedly many, many insolvent loans and companies in China. The prospect that these companies then either go bankrupt or become, as with the Japanese, their zombie companies, is one which concerns everyone, and certainly the Chinese. That's one part of it. That's the world growth story. About the only place there seems to be any growth or any economic optimism at the moment is here in the United States. How that plays out, we'll wait and see. But certainly in China and in the EMU, the other largest bloc in the world economically, a great deal of gloom. Do not be fooled, I'm sure no one is, by 7.2% growth in China. Remember when maybe 2 years ago, 3 years ago, when the Chinese governments said that the economy needs 8% growth to maintain employment, and by what they mean, of course, by default, is to maintain social stability. Remember how historically Chinese dynasties end. They end with rebellion in the provinces. The current Chinese government has almost all, I'll take that, give me a second on that. The current Chinese government has all the attributes of a new Chinese dynasty, and so they are concerned about that. They know their history in China. Let me answer that question. So why wouldn't the world buy the dollar? Well, they have. If you look at the DXY or the euro or against the yen, since the middle of the summer, since the early summer actually, the dollar's been on a tear. So in fact, they have. So we have already a lot of the concerns for growth, the growth side, already built into the dollar level. Greece, which I'll talk about right now, brings a new factor. Also, if, the growth that we're talking about is more or less 1% or less in the EMU, 2.5%, 3% in the United States, and somewhere around 7% in China. If any of those, that's what's more or less incorporated, priced into the dollar level now. If any of those change, better or worse, I think we're looking at worse right here. China starts growing at 5%, and they actually report it. The EMU goes into yet another recession, which it has not quite yet, although parts of it are. Or the United States growth slips from 2.5% or 3%, which is what most people expect for next year. Then we would probably, as counterintuitive as it seems, find further increases in the dollar. The other factor in today's lovely display of volatility, I mean, we all like volatility, no trading, no chance to earn or lose money. So we all love volatility. I used to call it the fifth horseman of the apocalypse, which was a rather grand and pretentious way of referring to it. Does anyone know what the first four are? I forgot to look them up today, so I can't tell you. Next time I'll look them up. Is that Greece is now back on the horizon. I wanted to put the Greek stock market, which is prone to volatility. It's a small base stock market. I think GDP is rising today because the British economy and the British currency is once again, as it has been periodically and almost continually since the financial crisis, looking like a good alternative to the euro. And let's talk about Greece for a second, and then we'll talk about deflation. Let me just backtrack a little bit. What happened today is the Greek government, Antonis Samaras, has called an election. What he actually called, and if people in parliamentary systems will be familiar with this, he basically called a confidence vote for the government. I believe the Greek system is a little different. They have they don't just have to win the confidence vote, they have to win by a certain number. I think it's 180. The government currently, out of 300, the government currently owns 155 out of, I think, 300 seats in the Greek parliament. And that is scheduled, I think, for the 17th. So the Greek government the current government of Samaras needs to win that confidence vote, or if they lose, they have to call an election. The election, I think, takes place in 2 months. Obviously, Samaras thinks that they will win the election and that the independent MPs, they're not all MPs, representatives, will vote with the government to prevent the calling of a general election. The reason GDP is rising, I mean, not GDP, but the sterling is rising, is because the general election brings up the entire euro crisis. Remember that from 2 and 3 years ago? And all the fun we had with that? Well, we may be returning to that, or at least parts of it. In the speculative interim, we're going to get lots of volatility. Why is that a problem? Because the opposition party in Greece, I think it's pronounced Syria. If there's anyone from the Hellenic lands who speaks Greek, you may correct my pronunciation. I don't know if that's correct. I haven't been in Athens in about 4 years now. Are leading in the polls. Syria. I don't actually know how to pronounce it, and unfortunately no one else has voice except for me. If they win, their program is to renegotiate the bailout agreements that the EMU and IMF and others have extended to Greece. Well, that promises a load of disagreement, volatility, and the end product is quite possibly the exit of Greece from the euro. Do I really think that will be the end? No, I don't. And the reason is, It will take an enormous amount of courage to do that. I'm not saying it's right or wrong. I'm just saying political courage, and the amount of turmoil in Greece will be tremendous. Not having been in Greece in 4 years since the EMU crisis blew up, I cannot say whether the amount of dislocation Greece has gone through since the bailouts, leading up to the bailouts, warrants such a thing. But it is certainly true in the history of democratic political systems, and certainly in Europe, that economic turmoil brings on political extremism. We have seen this. I'm not drawing any specific analogies, but it is without doubt true. And it is certainly within the realm of possibilities, within the realm of imagination, within the realm of investment horizons, that a victory for the Caesarea party would create enormous turmoil for Greece. It is possible that the threat, we don't know how this will play out, but that the threat of Greek departure from the Eurozone is enough to concentrate everyone's minds on what is going on in Europe. We shall see. But that is the source of today's volatility, and it is certainly something which is not going to go away. And if we're looking for a longer term, now it's interesting that you actually saw a rise in the euro today, but we'll see how that plays out. I have my doubts whether that remains the trend that euro will continue at. Okay, I'm gonna let that one go because that's not our topic today. But another thing to remember is that, let me just show you a chart here. This is, let me find it, the Italian 10-year bond. The Italian 10-year bond is yielding less than the U.S. 10-year bond. In other words, in the judgments of the credit markets, perhaps they're on too much caffeine or maybe different drugs. In the judgment of the credit markets as displayed in their prices, which of course produce the yields, Italian bonds are safer than U.S. bonds. Does anyone possibly believe it? Does that possibly make any sense? Well, it does in the sense, I mean, Italy doesn't even issue its own currency. The U.S. issues its own currency. If we need to pay off bonds, the country's broke. And you could say any country that has to borrow to meet its expenses is broke, which means everybody's broke. But the U.S. issues its own currency. So if they ever need to pay off a bond, they can just print money. It doesn't mean it'll be good for the dollar or anything else, but they can do it. You're going to get your dollars back. Italy can't do that. They have to pay off in euros. Ooh, interesting. Yet, the market judges the Italian debt to be safer than the United States. That's nuts, because it's not true. So what is the market banking on? The market is banking on not facts. The market is banking on that the Europeans will not let their system blow up. That if they have to, even Germany would permit the massive printing of euros in order to prevent something like that. That is possibly a confidence trick. And I don't mean a confidence trick in the sense of the types of con men that used to get in the back of my cab and try and sell me things that they assured were very valuable and looked valuable, but in fact were not. It's confidence trick in the sense that the markets have confidence in what Mr. Draghi and the rest of the Europeans say. They haven't done anything. Remember, we'll do whatever's necessary from 2 years ago to save the euro. They haven't done a thing. The markets haven't asked them to do a thing. The markets believe them with a very sincere and touching devotion. But that doesn't necessarily mean that it's true. The Greek yields took a rocket up today. Let's find the daily. Here's the hourly Greek yields, okay? But even this is mild if you look at it. Went from 7 to about 7.8, but back in October they were up at 9. So there isn't a lot of doubt yet that the Europeans will do this. Let's put another one up. Here's the U.S. 10-year, 2.20. Let's look at my favorite, the German 10-year. The German 10-year, 0.6. Slightly more than European inflation, which I think is running 0.3 on the year. So the Greek problem goes and will go if it becomes realer than it is now. Goes to the heart of the same issue that so roiled the markets 2 years ago. Back here, when German rates were 3.5% and Greek rates were 35%, and Italian rates, how far do we go? We're back at 7%, and Spanish rates, which are now down around 2% again. You got to love this. Spanish rates, 10-year, lower than U.S. rates. One would have to say, that the bond markets have abandoned their traditional role as guardians of reality. What's that thing that Bill Clinton said once? If I get to come back in another life, I'd like to come back as the bond market. Well, that role as a check and as a reality check on governments has been abandoned in the face of the worry of the financial crisis and the relentless interventions of the world's central banks. There is absolutely no way that Italian and Spanish bonds are safer than U.S. bonds unless you believe, as the markets clearly do, that based on any other criteria except central bank intervention. That's what the markets are telling us with all of this. So the Greek potential problem goes to the heart of that. Will it escalate to a fact? Are the Greeks really angry, distraught, disturbed enough to elect a government whose program may very well point to a departure from the euro? I can't answer that question. We will find out over the next few weeks. And remember when we're doing this. In December. Today is the 9th. Most money center banks, where I used to work, close their books as far as speculative trading goes on December 1st. That's what they used to anyway. What they will do, of course, is they'll price customers, and that's about it. And it's party month in the New York financial markets, which is true. But I'll not go into those stories. Those are from a few years ago. But there are a lot of parties in December downtown. Anyway, so but most everybody's at Midtown now. But anyway, the point being that if you look at, and I may do a webinar on this, if you look at the history of the past 10 years or 15 years of foreign exchange trading in December, look what happens in January. If there's a big move in December, it's almost always reversed in January. So when you're thinking of trading this month, keep that in mind, especially, which there isn't so far, if there is a trend that gets rolling, which we haven't so far. At least when I walked into the room, there wasn't any trend that was actually rolling. Okay. Let us now move on to our deflation topic. But we're going to have, it seems like we're going to have a pretty volatile month here. what the Greeks are doing is a potential shot at the heart of the European monetary union. We shall see how it goes. All of the okay, so what are we going to look at first here? Let's look at the EMU. Unfortunately, a lot of the EMU statistics I could only get were at back to 97. I couldn't get the ones where they put together the inflation rates of all of the components, all the component countries of the EU and run them back 50 years. This is EMU CPI. But let's take a step back. Deflation is in my mind, a hugely misunderstood phenomenon. And that includes, forgive my effrontery, the way is it approached by economists as well, especially by public economists with public responsibilities such as Ben Bernanke, the former president of the Fed. Now, what do I mean by that? When an economist, Mr. Bernanke, Paul Krugman, the other probably most famous economist in the world right now, at least in the United States, deal with these topics, they have responsibilities beyond as they perceive them, in some case actual, in some case polemical, in one case actual, in one case polemical. They perceive them through the lens of their responsibilities. Mr. Bernanke's responsibility as chairman of the Fed was, especially in the current situation, with a divided government, the caretaker of the U.S. economy. Nobody else was doing anything, frankly, so it was left to Bernanke. And the politicians are more than willing to let them do this because Mr. Bernanke is insulated relatively from political pressure, and nobody has to take any blame for doing anything wrong. So there, what do you know? Now, what is deflation? You know, the history, and let me find a long chart. I have a long chart here. What's the longest chart I have here? 1910. Okay? This is a chart of U.S. inflation. Now, the problem with this chart is this is a year-to-year chart. So when you do year-to-year charts, what that means is that if you had a great fall in price, then the subsequent periods measuring that are, of course, going to be overstated, which is why I put in the averages here. The moving average here, this is a chart of U.S. inflation going back to 1910. And when you talk about deflation and some of the topics I'm going to talk about here, you must, and I'm trying very hard, to put it in the historical context. Because deflation is a historical fact, and it's relatively rare. But it has to be dealt with in terms of its place in the history of industrial societies and in the history and the changes in prices. Okay, so this is a chart of U.S. inflation going back to 1910. I don't know where they got the numbers from in the early part of the century. I can't tell you. One of the things that the Roosevelt administration did when they came in 1932, was they put in a number of new measures to try and get better statistics out of the U.S. economy. But you can actually find price records, maybe largely speculative, going back hundreds of years, which are fascinating. For most of human history, where people were pricing things with money, prices were relatively stable. If you bought, I don't know, a pound of grain in 1400, and then you bought a pound in 1600, and then 1800, the price was essentially the same. Inflation is an invention, or at least an invention is probably the wrong word, is attendant on largely central banks. And I'm not going to get over into the wilder shores of speculative on central banks and everything else, but look at this chart. Okay, remember the first central banks were back in the U.S. central bank was the early part of the 19th century, and then it was thrown out by Andrew Jackson and put back in. But the Fed is actually created about 1912, I think, 1910, in its modern incarnation.
which is why I'm sorry we don't have it going back much further, because then we could look at the actual price record back in the 18th century and 17th, 16th century. But those, the problem with those price records are they're largely speculative anyway. Okay, so look at what we have. There's a relative, let's put it this way. Inflation in the modern world has been very, you can divide it between periods of relative quiescence and periods of enormous volatility. The two most, I don't know too much about this area right here, but this one I know right here. This is the depression. And this is right here, this great fall, is the peak of inflation from, and you can see the trend up here from the 50s and the 60s, which has to do with government spending and not taxing. And over here, we've had a fall off since then. So the historical context of inflation, disinflation, and deflation. The basic lesson from this chart, periods here, period here, these periods here, this period here, and this period here. Those price changes, those deflationary price changes, are what I would call cyclical. They were promoted, as with the one we just experienced right here. We all just lived through this, by a collapse in demand. When the financial crisis hit, what happened? Everybody suddenly stopped buying. I did. You did. Everybody got really worried, and they pulled in all of their spending. And what happened? All the businesses still had inventory, which they had to get rid of. And what do? They cut prices. If you look at this chart, you can see that those types of occurrences, those are deflationary occurrences. Prices actually became slightly negative. Here's the zero line. They were negative in 1920. They became negative during the Depression. They barely became negative here in this recession after the end of World War II. Remember, after the end of World War II, government demand plummeted. In 1945, in late 1944 and into 1945, the government started canceling all sorts of procurement orders for the war because the war was won. They didn't need more aircraft carriers. They didn't need more tanks and guns and everything else. So the demand plummeted. Plus, millions of soldiers were demobilized, hadn't found jobs yet. Hard to buy goods if you don't have a job. So these recurring bouts of deflation were demand-driven. This is the analysis that Mr. Bernanke used and the Fed used to analyze deflation. Now, they know that it was demand-driven. The reason that, remember in the early days of the financial crisis, Mr. Bernanke and others on the board were more than willing to talk about the dangers of deflation. Now, why were they willing to do that? They could look at this chart as well, and they could see that the cycles were begun and fostered, and they were brief by collapse in demand. So why would Mr. Bernanke and the Fed be so inclined to stress the danger of deflation when they had to know it was probably a cyclical occurrence? Well, the reason is because the danger of deflation is twofold. One, that by pulling back, by keeping people reticent to purchase, you exacerbate the cyclical collapse. Rather
once the deflationary mindset, and inflation has a large psychological component, one which is large, which is pretty difficult to statistically get a hold of. You know, there are in some of the sentiment numbers that you can get out of the United States, the consumer sentiment numbers, they'll ask people what they think their inflation. Maybe they'll give them a range: 2-3%, 5-6%, 100% in 6 months or a year, and people will answer. But frankly, nobody has any clue. So those numbers aren't really worth anything. It's very difficult to judge a culture's affinity for believing inflation. It's much like the crime issue. There has yet to be a good, in my mind, explanation for why the crime rate in the United States has plummeted so dramatically over the past generation. But anyway, that's another topic. So the onset, and certainly the entrenchment of a deflationary attitude, exacerbates the cyclical fall in prices. That's one aspect. Certainly if you look at the Depression here, right, we're on the same scale. The fall in prices, both the depth and the longevity of the fall in prices in the Depression was much greater than the collapse and duration in the financial crisis. And defenders of the Fed, and I would probably agree with this, will say that one of the reasons that it was much less this time is because the Fed was there throwing money at it, cutting rates to, you know, I should have put the Fed funds rate on this as a comparative. I forgot to do that. I apologize. Fall of 2007, Mr. Bernanke's cutting rates. So the lesson that Mr. Bernanke learned about deflation is you do everything you can to prevent it. Because once it becomes part of the psychology, it's hard to get rid of, and it makes everything worse. So we have that aspect of deflation. I think the second aspect of it in this time was that nobody knew where we were going with this. We can all tell our children. I haven't told my children about the terrors and the fears of the financial crisis. I remember talking about them with my wife, who was on Wall Street at the time. It was a fascinating thing to discuss. And she was in the midst of the asset-backed market because that was her market. So it was fascinating stuff to discuss and what people were saying. But the other thing that Mr. Bernanke looked at the time was that nobody knows what's going to happen here. With deflation, what gets in, and the terrors looking forward of people. So for those reasons, we have a very robust approach to the deflationary changes in the economy, which were actually cyclical. Now, there is, to my analysis, another type of deflation, and it's actually more disinflation, at least so far in the United States, but it's true in Europe as well. Starting back here, so we have the cyclical deflation, which is part of a collapse in demand. A collapse in demand, a very rapid collapse in demand, which is what we've seen in the instances I just spoke about. There's another type. Since or at least it's different in how it affects the economy and in its origins, I believe. The cyclical deflationary collapses we've seen are amenable to monetary policy and to financial and to fiscal policy because they are part of the business cycle. A very common occurrence for hundreds of years in capitalism. The central banks have gotten to the point, originally under Mr. Greenspan, and I think it's true now still, of the idea that they can moderate, at the very least, the business cycle. That has not really proven to be the case. At least we'll see it out. The attempt now is unprecedented in capitalist history. We will see how it plays out. So let's move to that one now. This decline, I drew it to the peak here. Let's take a look at, well, let's leave it right here for a second. But if we draw it, say, from here to here, on this long-range chart with these huge peaks, you don't actually see it as well displayed. So let me see if I have, excuse me, a shorter one. Okay, well, we have the same chart here. Hang on, here we go. Oh, that's M3. We'll deal with that in a second. Okay. This is CPI monthly. Okay, this is a better chart. This is what I was looking for. Since Paul Volcker and putting interest rates up to 17%, does anybody remember that? I barely do. I was in my very late teens in those days. Central banks, and this is not just true of the United States, it's true around the world, have been very successful at diminishing inflation. We've gone from an average of, say, 5% down to an average now of less than 2%. Until the past 2 or 3 years, that was viewed as an unalloyed triumph of central bank policy. Inflation was viewed as a bad thing. The natural result, conclusion, if you will, of that policy through this period throughout here, when inflation was going down, inflation expectations were going down, this was viewed as a success of monetary policy, a success of central bank policy. I don't recall any great concern during those 2 or more decades of where this might lead. Now, the concern is the opposite. Inflation is too low. Everybody's suddenly setting 2% targets, but they're looking at them from the wrong side. We have a long comment here. Wow, I appreciate that. Let me deal with that in a second. I'll read about it in a second. Yes, that is true. I would agree with that. But anyway, let me finish my thoughts here, and then we'll move on to that, because I do want to talk about Japan. So the natural end of policy was never considered something to worry about. If inflation keeps diminishing, eventually it's going to go to zero. The result of that policy is the chart that we're looking at. It is that 30-year decline in inflation. Well, if you change inflationary expectations in the economy, you change them long term. And they lead eventually, or they could theoretically lead eventually, to deflation. You know, deflation and inflation were always viewed, and this as a monetary phenomenon, purely and always a monetary phenomenon. And so the central banks, I'm sure, although they didn't say it, always thought that if they needed to pump up inflation, they could simply pump up the money supply. So on the far extended end, when people thought we might have too little inflation, they thought we could just pump up the money supply. That has not turned out to be the case. You look at the Fed balance sheet, not just blooming, exploding. The ECB talks about wanting to get back to where it was in 2012. And even if they do, there hasn't been a concurrent increase in inflation. It is not always and solely a monetary phenomenon. Let's take a look here. I have some monetary supply figures. We're going to talk about Japan right now, because Japan is, the other side of this. This is a chart of Japanese inflation going back to 1975, and the M3 money supply, which unfortunately I can only get numbers back to 1995. What you're looking at here in Japan, except for these relative peaks, has been exactly the same type of long-term decline, central bank success in quelling inflation that you saw in the United States. And if you look at worldwide inflation rates, you say the same thing. The end product of this is simply an advanced case of what we saw in the U.S. Remember the two sides of this. We have demand and supply for inflation, demand and supply for money. Supply, of course, you could say, is the monetary, the M3, the M2. The U.S. doesn't keep M3 anymore, just keeps M2. The demand side is the demand for loans and money, and circulation used to be called velocity of money in the economy. But there is another factor in here which is on the demand side as well, and that is the demand for goods in the economy. And I think that is a demand which has not been factored into the theoretical approaches to how easy it is to take an economy out of deflation. That, in my analysis, is the structural aspect of deflation. Now, I'm going to talk more about that in a second, but let me just look at these comments here. Since I ask people to comment, it behooves me to read them. Yes, that is true. You are correct. Inflation, certainly the hyperinflation that you're talking about, which we have seen instances of it going back to the Roman Empire, has been far more devastating to economic health and to personal economic health than deflation. That is correct. Now, you're right about all that. Not only deflation, but relative price stability. That is true as well. That is correct. And where is the inflation out of QE? Asset prices. I think it's really that simple. Okay, so I agree with both of those. Another aspect of inflation, which is very difficult, again, to categorize, but is certainly true, is that the massive debt of modern industrial countries, of modern democratic industrial countries, where it's far easier to spend to satisfy the electorate than it is to raise taxes to pay for it, is without question a factor in modern inflation. There is no way Greece ever gets out from under its debt without it being forgiven, without inflating it away. That's true of Japan as well. It's becoming true. It's true of the United States. There are two ways to get out of that kind of debt. If you're amassing debt at a certain rate, either you amass debt at less than economic growth rates, in which case the debt slowly becomes smaller proportionally than the size of the economy and you can sustain it, or you inflate it away. And in mature economies, it certainly looks that the only way out of that kind of debt, without forgiveness and essentially an economic collapse, financial collapse, is to inflate it away. This is never spoken about by central banks that target 2% inflation. It is absolutely true. And one of the reasons you could say the central banks are never concerned about the size, the inflation rates from the being too low throughout the period from Paul Volcker on is because that hadn't become a consideration, and it is now a consideration. But okay, so back to structural deflation. So remember, it's my contention that deflation is not just a function of the Milton Friedman, always and everywhere supply of money, but also a factor of the demand for goods within a society. Since what we're pricing in inflation is demand for goods, that if something changes the demand for goods long-term, structurally, then the amount of money is not going to matter that much because it's demand that is being changed. One thing that's true about the idea of inflation is always, and deflation, they're the same thing, remember. What we have now, of course, is disinflation. Prices going down, but not yet negative. One thing that I think was, or two factors, well, they're really the same factor, and I'll talk about it in a second, that were involved in, sorry, sorry, but I have a sore throat, and I don't want to start coughing like I did the last time. So one of the product of having young children is lots of kind of niggling little diseases or infections that come around. One of the factors that is, I believe, not counted sufficiently in the calculations of inflation as a monetary phenomenon is the demand side of goods. If you assume, one, that as population rises, demand rises, and that the business cycle continually renews itself, then you can base an assumption in your equations that the demand for goods, once the cycle turns, will return to its prior level. Population, the makeup of the population is relatively stable. So demand for goods, which of course is one of the factors driving inflation, not just the money supply, will return to its prior levels once the business cycle recovers and is on the upswing. What if that is not the case? Let's take a look at Japan retail sales. These are Japan retail sales. This is a very busy chart. I know that. Retail sales going back a little bit 30 years essentially. This is the demand side of goods. And those trend lines overstate the condition of demand in Japan. In fact, the best line is probably the green one right here. And I haven't done any kind of analysis mathematically to know if that decline matches, you know where I'm going with this, matches the decline of Japanese population. But my guess is there's a correlation there. So this is the demand side for goods that cannot really be corrected by monetary policy. This is the population aspect. This is the changing not only of the numbers of people, but of the makeup of the population. Japan has a rapidly aging and shrinking population. This chart, the deflationary chart, I mean, the zero line is here. The zero line in retail sales is here. Let's take a look at Japanese CPI, 1975. Japanese CPI. The zero line is, where's the zero line? Right here. Okay. Sorry, I should have illustrated that better. The decline in here. Let's put it up with the. Let me put it up with the M3. Here. Do we have M3 on this? CPI. Okay, here we go. There's M3. It's the M3 money supply, and it mirrors the change in CPI, and it leads it a little bit, of course. However, it doesn't change the trend in CPI. The long-term aspect of CPI, regardless of monetary policy, is closely tied by these charts and by my analysis to demand in the economy and population. Okay. Now let's move to the EMU, since that was the topic of what we're talking about here. Okay. EMU. Now, the reason I went to Japan is because, one, this case is more advanced in Japan than any place else, and two, you can get better records going back longer in Japan. Okay.
This is EMI CPU, going back to 1997. This is the 5-year moving average, which is probably more appropriate than anything else, from about the financial crisis. You have a decline from about a little bit, maybe 2.3 to 1.7. Okay? This is along the line of monetary supply and prices. CPI is the white, yellow is money supply. And as a standard analysis, you can see that the money supply leads the inflation. This is money supply moving average, 3 months, also declining average. So where does all of this lead us to? Okay? This is retail sales. Remember the decline in CPI. Not deflation, but the decline in overall prices, regardless of money supply. The money supply changes absolutely have an effect on the overall subsequent inflation rate. You pump up the money supply, you get a burst of a rise in inflation. But it does not and has not changed the overall trend lower of inflation. So this is the difference. The money supply remedy to disinflation is accurate when describing cyclical disinflation and deflation. It seems to be far less accurate when describing and attempting to change a long-term trend, the long-term trend. I mean, not just in Japan, not just in the EMU, not just in the United States, in all of them. There is, without doubt, an aspect of this issue, deflation, inflation to disinflation, potentially to deflation. That is quite a bit deeper structurally than monetary policy. It's probably, at least in any idea that it can be affected, deeper than fiscal policy. Could it be a cultural attribute? Or could it be, remember, the history of prices going back 1,000 years or going back 600 years or whatever it is one of relative stability. The volatility of prices is an industrial world phenomenon. Not completely. There were periods of hyperinflation, as I mentioned earlier, back in the Roman Hyper, largely related to the debasement of currencies. But that's not the case now. Although it is the case at the moment, you could make the argument with the policies of the central banks. But in fact, currencies are not really being debased to any of the same degree. So if we are in a world where the long-term structural aspects beyond monetary policy leading to a decline in inflation is affected, or if you will, driven by the slowly ebbing demand and the changing complexion of the demand for goods and services in an economy. It is without doubt true that older people consume less services and goods
than younger people. That families, especially families with young children, 2 6-year-olds, we consume a lot. And it's only going to be rising for the next 15 years, are the consumption engine of a culture. And if that group is slowly ebbing, as it is already dramatically in Japan and in Russia, but I didn't look at Russia for this thing, then the overall demand parameters of the society will change. And one of the things that will change along with them are the inflationary potential of that culture, of that economic entity. When you look at Fed policy right now, Fed policy has been uniformly unsuccessful at the moment in sponsoring inflation. When you look at ECB monetary policy, let's look at Japan. Let me go take a look at Japan. Japan CPI and M3. Okay, we did get a burst in prices from down here to up here in inflation. Now, I don't know how they calculate the CPI. I don't know if they include stock market prices in that. They might, which could account for a portion of that. But this peak is not much different than the peaks we've had here. The question is, will this burst of monetary policy in Japan change the long-term decline of inflation? Think of it from a monetary policy point of view. Historically, inflation rates and central bank rates, interest rates, were stable. What if we're returning to that type of environment now? You know, it is certainly true that population increases are a function of the Industrial Revolution and the advances in public health to a great degree. All of the relatively easy to prevent diseases, which used to, you know, I have there's a very old cemetery near my house, going back to the middle of the 18th century. And if you go through that cemetery for the gravestones, you can still read, especially for someone with young children. It's very sobering. In a way, it's a little depressing. The number, I'm sure we all know this, but the gravestones really do bring it out. The number of children, of young people, are phenomenal. The number of old people are very small. That is the source of population increases. If we are returning to a world prior to that, where populations grew very slowly, then it is more than likely, from the evidence we've seen so far, that we are also returning to a world of permanently low inflation. And if that is the case, then the central bank policies of attempting to use interest rates as a spur to growth are going to fail. At least they're going to be much diminished in their effectiveness. Back to the EMU. Let's look at the EMU. Give me one second. Inflation rates, and do I have a GDP up here? I think I have a GDP up here. Let me find it. Oh, I don't see it. I thought I put it. Maybe I forgot that one. Sorry, I thought I had a EMU GDP number. Oh yeah, here it is. Here it is. Sorry, I do have it. Okay, it's EMU GDP. Again, we look at this chart. We see a slow decline of both GDP and inflation. The possibility that the structural aspects of inflation of retail sales, of GDP, are reaching a point where they are no more amenable to return to prior rates as a function of monetary and fiscal policy. In that case, the ECB attempt, which they haven't even started yet, to pump up inflation to prevent deflation, which they're edging very close to. This year-on-year chart, the white is inflation, is 3.3% year over year. Now, you can certainly make the case that the demand in Europe for goods, not demand for money, the demand for goods, is much diminished over the past couple of years, since 2011. That's clearly the case. You can just take a look at it in the GDP. That's clearly true. But the aging of Europe's population must, since this is a human factor, have the same type of effect that we have seen going back much further and much more pronounced in Japan. The central banks, let me give you another idea. The Fed is forever talking about raising rates, getting back to a normal. I have a column coming out probably tomorrow called The Lure of the Normal, Fed rate policy. The major reason the Fed keeps the seem wanting to go back to higher rates is because higher rates are normal. Okay. Well, when normalities change, as Keynes said, when the facts change, sir, I change my mind. What do you do? If all of these things are true and we are entering permanently a lower growth, lower inflation environment, lower population, then it doesn't matter a great deal what normal was 15 years ago. It matters what normal is going forward. And if the Fed is, as they keep saying, data dependent, where is the data that supports higher rates? Traditionally, historically, a huge expansion in the money supply, which actually hasn't happened yet, will prompt inflation, always and everywhere a monetary phenomenon. But what if we're not in that world anymore? The Fed may assume that inflation will be coming, but there isn't any proof of it so far. There hasn't been for almost 6 years. If, as everyone expects currently, and the Fed itself expects clearly, they raise rates sometime at the end of the first half next year, what is then the prognosis after that? Traditionally, historically, when the Fed and the EMU, these are both banks in the same situation, different degrees, same situation. Banks, when they start raising rates, it's the beginning of a cycle to anti-cyclical for the business cycle. That's the purpose of a central bank rate cycle. The assumption is, as I said earlier, that demand returns to the prior levels and the central bank is attempting to moderate the excesses of the business cycle. That's the logic behind central bank monetary policy for the past 2 or 3 generations. 2 generations at least. We can debate that. But if that has changed, then the assumptions that go with that cyclical policy, in other words, put it this way, I think if we get a Fed increase in the first half of next year, they're then going, unless there's inflation, unless the U.S. is suddenly growing at 6%, which I don't see, the Fed is going to say, not yet. The return, both to the level, meaning we're not going back to 4%, and the duration will be, the level will be lower and the duration will be much longer for Fed rate policy. Okay, I run over a bit here, and that applies equally. Let me just look at the. Let me finish one more thing, and then I'll answer the questions. This, I think, is absolutely true of the EMU.
The EMU's biggest problem with deflation and lower inflation rates is not money supply. It's population. And the EMU will, if we drop closer to deflation, will do something to pump up the money supply. They'll do something with sovereign debt, especially when you are looking at this Greek issue. But I don't think the ECB is going to do anything till next year. So they will respond with the same types of monetary tools that the Fed has done because they have no choice and they have no other options. And they are in a position, just like the Fed, both by analysis and by responsibility, demanding action. Mr. Bernanke viewed the inaction of the Depression era Fed as one of the great mistakes in monetary and fiscal, I don't know, fiscal, but monetary policy by a central bank. He's probably correct. Certainly that's what he enacted when the Great Recession, the financial crisis hit. You will get the same type of response from the EMU. And when you get it from the ECB, you will see a further fall in the euro. This is something I think we can definitely look forward to as policy in the ECB and in the EMU. Okay, let me take a look at some of these questions here. I don't know. I think they definitely have, as far as talking about modeling the inflation. Yes, that's pretty common. I've seen that. No, inflation does, because you remember, inflation is benefits the people who have loans, who have borrowed, because the ones who borrowed the money, not the ones who lent it, because you pay it back with devalued currency, and deflation is the opposite. So, yes, they have certainly modeled that. It's not something that the central bank is going to, or anybody else in government is going to come out and talk about, because consumers don't like inflation. From a consumer point of view, deflation seems like a better deal, or at least low inflation. And so it's not something, since the central bank is clearly trying to engineer inflation, although what they might say, if they ask specifically, and they have been, that they're not trying to engineer inflation, but they're trying to prevent disinflation and deflation. But that's rhetorical. They're the same thing. So yes, it has been modeled. There's no question about that. Guaranteed. You don't see them talk about it very much. It's kind of an esoteric concept, but it's definitely true. Another reason it's not spoken about in a democracy is because by and large, consumers, meaning voters, the electorate, don't view inflation as a benign occurrence. So governments don't mention it. Should governments reduce debt? A lot of these things are almost, they seem like they are beyond the active, conscious control of governments. Debt reduction, spending reduction, is very difficult in a democracy. Look at certainly a consumer-driven democracy, which is what we are here in the United States and many other places as well. The pressures from the social services side and the consumption side are such that growth becomes the mantra, until recently, of governments. But expenditures, there's that, like they call the iron law of life, on a personal level, on a family level. Expenditures rise to the level of income. It seems always to be true. It's very hard to save money. The iron law of governments is expenditures
rise beyond the level of income, always and inevitably. So where this leads, logically, it should lead at some point to the type of hyperinflation which actually devalues debt. I don't actually know. And I'm not sure you pays your money or takes your choices. Yeah, these are my mother's favorite phrases. I don't know, and I can't give you a good analysis of where this type of structure leads. There is a great website, which I'll give a boost to. It's called Zero Hedge, and it's very much the pessimist's view of all of this. Take a look at it. It's fascinating to read. It's not necessarily true, and one thing we always forget about, much as with the drama and the arguments over peak oil, is that, or the fact that in the back in the 70s and early 80s, there are many analyses that the world's going to run out of money, everybody's going to starve. None of these things happened. Human culture is remarkably adaptable, and I think that adaptation, that ability to adapt, will be displayed in the financial system as well as in the technological and cultural systems. Okay, folks, we ran about 15 minutes over. I hope this was entertaining, probably not so entertaining. I hope it was at least informative about the very interesting, fascinating in my mind, problem of deflation, inflation, and its cultural aspects. I thank you all for attending. I'm always very flattered that people will come and listen to these things. I will be doing another one. I have to set it up. There is only one this month. In January, we will be doing, hopefully I'll be doing 2 again for FX Street, and I will also be doing 2 a month for Worldwide Markets, my firm. If anyone has any comments, criticisms, or jokes, please send them to me. I'll be glad to use them. I will put my email address up there. Please contact me if you have any comments. Again, I thank you all very much for attending, and everyone have a lovely week. Take care.